Welcome. So, Doc, so good to see you. I believe this is episode 108. How have you been? What's been happening? What's happening with that market?
Yeah, it's we're getting to the end of the year. One more week of the auction market left, and then we're on holidays for until February. The markets don't really shut down. It's interesting, a lot of those regional markets are still active. The Gold Coast is a big market during January, and some of those other coastal markets, such as the Mornington Peninsula and Central Coast in Sydney, Mornington Peninsula in Melbourne, are actively looking for buyers because, of course, people are on holidays and it's like, oh yeah, let's live here. I love it. But the Gold Coast does have a lot of action through January. But the big picture is we really do slow down. We need a break. All those hardworking agents out there, all those buyers and sellers, they've bought, they've sold, now they're thinking about enjoying their properties or thinking about where we're going to go next. It's been a good year, 2024. It has been a good year. We're going to match. We haven't got our final data. I was going to sort of give a bit of a tease today about what the final data would look like for the year, but let's wait until we get the full December figures. But it's going to be very similar in terms of overall growth in 2024 compared to 2023. So it wasn't just a rebound in 2023 and then, nothing. It's been another similar year. So we won't get to double figure nationally, but we'll get close to it, around about 7%. But the when we look a little deeper into the numbers, the big three, Brisbane, Adelaide, Perth, wow. Can I say that again?
Yeah.
Wow. Is that so big? The numbers coming out of those three capitals. In fact, over the past 3 years, they've grown around about 40%. So if you're a homeowner in those capitals, you'd be pretty happy about what's happened over the last few years. But solid results again in Sydney. Melbourne, really still dragging the chain a little bit. But we've got some news today, which might be good news for that Melbourne market. Hang on. We've had some big news this week, some really big news. I'll say that again. Some really big news this week for the housing market. And a bit of a surprise, but nonetheless, we'll talk in depth. So shall we get started? We've heightened all the anticipation. People are just saying, come on, tell me. What's happening?
Tell me the big news.
Tell me the big news. Well, here comes the big news. So my housing market, every week in conjunction with our good friends at Infinity, we bring you the Wilson Weekly, which is all about what's happening over the past week in housing markets. It's designed to inform all the buyers and sellers out there and everybody in general what's happening currently in the housing market. And that's the big word, current state. So we bring not just the data in terms of prices and rents, but also the correlating evidence that reflects what's likely to happen in the housing market. And we've got plenty of correlating evidence today. So current state, future prospects of your housing market. And it is 108. Gee whiz, our time flies when you're doing the Wilson Weekly. So we're still getting a lot of views, which is good news. And we're always updating what we offer our viewers, and we've updated our little app, which we'll talk about at the end. So stay tuned here. This is about making informed decisions, and that's what we want everybody to do. We want to provide them with the knowledge base to make informed decisions. There's so much BS, if that's a word I can use, out there in regard to the prospects for housing markets that you just got to be very careful making decisions, particularly about the doom and gloom and boom type of narratives that go on. So that's enough. I'm going on and on. Let's get started. And it is the second last week of the year in terms of the market, week ending Wednesday, December the 11th. This coming weekend will be the last auction weekend until February in the main capitals. And of course, we're all, I hope you've done your Christmas shopping, because tick, 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 you're running out of time, so get onto that. It's only 10 days away or something like that. So get onto that and get ready for the Christmas feasts, etc. Okay, so week to Wednesday, December the 11th. We're going to look today at the latest RBA interest rate decision, which was brought down yesterday. And dare I say, it was a little bit of a surprise. Certainly the
Oh,
RBA has changed its tune to some degree
interesting.
after quite a consistent period of singing off the same note, of the same song sheet. It's a little bit different now. And you got to read between the lines to some degree, sift through those tea leaves of what the Reserve Bank says. But I think most did pick up that, hey, this is a little different what they're saying in their decision, last decision for the year. Next decision is in February. So we're going to have a close look at that. I think it's particularly important for the prospects of the housing market next year. It always is, but it's different because it's changing a little bit, the outlook. We're also going to look at the latest November house and unit rents a bit late in the season for looking at that, but we'll look at it anyway, the latest house and unit rents. By that, I mean we usually have that at the beginning, very beginning of the month, but we're a week out of that because there's been so much news. And as usual, the latest auction data results. So, drum roll here. The RBA, no surprise, has left interest rates on hold over December. So that's the ninth consecutive steady decision. So it was not really much of a surprise. In fact, every month this year, rates have been on hold, or every month there was a decision. So the ninth consecutive steady decision by the RBA. And, we've had 13 interest rate increases since May 2022, which is when we began increasing interest rates. And that was the first increase in interest rates for 10 years. 10 years. That was the first increase. So it obviously had effect on the housing market. A lot of negative commentary regarding the prospects for the housing market with higher rates. But really, other than a little bit of a tracking backwards over 2022, it did nothing, and we bounced back last year. And the economy has continued to be quite strong. I used to say very strong, but now I'll say quite strong. So the jobless rate remains low. Jobs are surging, not as much as they were. The unemployment numbers had fallen this year, although they have started to rise over the past month of data, which was October. We have a record high participation rate, which is great because it means we're dragging people into the workforce at record numbers. So there's plenty of jobs out there. Retail sales are still high, well above where they were before COVID. Now, of course, this is retail sales based on the value of sales. So, inflation's pushed those value up. And also migration's pushed that up. So we need to take those numbers with a grain of salt. But nonetheless, they're still quite robust, given those interest rate increases. But we had some data out last week, which was the GDP data. And of course, GDP is gross domestic product, which is a statistical measure of what happens in the economy. Now, you sort of take GDP with a grain of salt because there's a number of factors there that work its way into GDP, the trade position, what's happening with government spending. So it's not what you'd call a real economic measure, even though it is the economic measure, such as retail sales or the unemployment rate. But nonetheless, it was not a shock, but we did see another quarter of falling GDP. And the annual rate of GDP also continues to fall. Now, I think that this has changed the mindset of the Reserve Bank. I think the Reserve Bank and its commentary sort of reflected this, has become a little bit more concerned about what's happening in the economy. It really hasn't changed markedly. Even that GDP number, and we'll have a look at that in a sec, isn't shocking, but it's certainly still trending downwards. And government spending is what's supporting GDP. So if we took government spending away, it would be a little bit more sobering. But I think that, and the unemployment numbers are still good, low fours. Yeah, unemployment numbers have risen. The number of unemployed have risen, the jobless, but we're still creating a lot of jobs. Now, the latest unemployment data for November comes out this week. And I think that will be very interesting to watch. You see, you've got to understand this. The Reserve Bank has a dual brief. Its brief is to keep inflation under control. It has a target range of 2 to 3%. So that's its range for inflation. And it also has a target range of full employment. So it's not just inflation. It's also the performance of the labour market, and that's full employment that it's aimed. So that's what it's aiming to do with interest rates. So we've certainly been really focusing on inflation over the past 2 years, 3 years, since the breakout in inflation did all those stimulus packages. But, and we've sort of ignored what's happening in the economy, because the economy's been, hey, whoopee, really strong, you know, and it's still pretty strong, seriously. But I think the Reserve Bank has just started to think a little bit more about its brief in terms of the economy. So it's sort of gone from the big focus on what's happening with inflation to a bit more of a balanced narrative. And that's about, hey, yeah, we're going to look at growth as well. So it's a little bit, I wouldn't say mystifying, but the Reserve Bank up until now has been very dogmatic, very precise. Yeah, we've got to get to the position of getting into the midpoint of the range, which is 2 to 3%. That is, we need to get to 2.5% with our underlying inflation rate, which is its preferred measure, over a quarter, not over a month. So sustained means not just 1 quarter. It means, over a couple of quarters at least, I would suggest. But it's sort of changed what it's saying now. And I'll just show you some of the from what it's been saying over the past year or so. So Reserve Bank said in its meeting, these were the notes that it released from its meeting on its decision, that sustainably returning inflation to target within a reasonable time frame remains the board's highest priority. So it's its highest priority, but it's not its only priority, if you know what I mean. So that's a little different. Okay, that's fine. So returning, inflation to target. So, and it said, well, headline inflation has declined substantially and will remain lower for a time. And that's because we've had that big fall in the price of oil, and we've also had the big price in the fall of electricity costs. Thank you, government. It's saying that underlying inflation is more indicative of inflation momentum, and it remains too high. And it does, because the latest underlying inflation data, which takes out the volatile elements such as fuel and electricity costs, which have been volatile recently, it remains too high. And it was 3.5% and rising over October, which is the latest data. So I'm saying, yeah, it's still too high. And it's saying it will be some time yet before inflation is sustainably in the target range and approaching the midpoint. Now, you understand that it's approaching the midpoint, not at the midpoint. What it's been saying is, hey, we need to get to the midpoint, 2.5, and then we've got to be there for a couple of quarters. Basically, that's what it's been saying. Now it's saying, we're looking to approach the midpoint.
Not there.
So, so you see what I mean? It's a little subtle. Perhaps we're not being as definitive, saying, hey, we've got to get to 2.5% and we've got to get there for 2 quarters, or else that's it. Interest rates stay where they are. So I'm thinking, and others too that noticed this, and the press conference yesterday with the Reserve Bank governor was very interesting, because a number of journalists, to their credit, picked up that there had been this little change, a bit more dovish, if I could say that, in regard to interest rates in the commentary. And there was a lot of sort of waffly, weaselly words coming out of the governor, ducking and weaving, to the answers, with the answers to the questions. So you couldn't nail it there, but they were very, sort of maybe this, maybe that, and saying we don't rule anything in, we don't rule anything out, which is what they've been saying for a while. But that's been really directed at the prospect of higher interest rates, not lower. And the last little thing that I picked up out of that commentary is that they're saying that the recent data is consistent with their forecasts, which is sustainably in the target range and approaching the midpoint, But then they said the board is gaining some confidence that inflation is moving sustainably towards the target. You get me? Right?
Yeah.
Moving, not at it's
we're not there yet.
Moving. Right? So these little subtle changes make you think, hello. This is a little bit different because, we're talking about moving, approaching, right?
Yep.
So it's more about not getting there. Hey, we've got to get there. Oh, that's it. Forget it. No interest rate cuts. Now it's about, hey, we might be happy just to see it moving in the right direction. And I think that's what they're changing because they're worried about the economy. So they're sort of saying, okay, we might have a problem with the economy, which means it might be prudent to cut interest rates ahead of a growing sense that the economy is not performing as well. So we want to sort of get in before, but they want to be able to say, oh no, we didn't say midpoint. We said approaching midpoint, moving towards the midpoint. So we said that. So, hey, we're not telling fibs here. But this is, look, it's a tough gig, the Reserve Bank gig. And that's why you shouldn't really be pedantic as they've been in terms of setting that, we've got to get to 2.5%, because this is a change, subtle change, and they can move backwards and forwards. And as I said, there is a bit of ducking and weaving that goes on here because it is difficult to monitor the economy. So many things can change and do change. So big picture, and we'll look at the cash rate. You can see there it's been flat all year. And definitely inflation, headline inflation's the lowest it's been for some time, but that's due to those factors of lower fuel costs and electricity. And but underlying inflation actually picked up over the last monthly data. So, okay, this is the GDP. You can see how it's really started to go down and down and down. So this is the annual growth rate of the Australian economy as measured by the gross domestic product, which is the headline or the head statistical measure of how we're performing. Yes, we have other performance measures like retail sales, like, the unemployment rate. But this is sort of the big picture energy. And I think this is sort of like, and maybe there's been some conversations with the government, with Treasury about, hey, we need to make sure that we've got enough stimulus in the economy to sort of offset what might be, a longer term downward slide in our economy. And I think that is what's behind that sort of change. But just to finish it, what I think it means, and we've been saying quite clearly here, and we're always guided by the facts at My Housing Market and Infinity. That's why we get it right so much of the time. But when it changes, you got to understand that change. Now, up until this week, the Reserve Bank has been saying, we don't think interest rates will fall until 2026. Absolutely no ifs and buts, because that's when we will get to the mid-range sustainably. All right. Now they're saying a different thing, that it's moving in the right direction. And that the economy is, So I would suggest now that we have a live interest rate decision in the offing, given the data as it comes through. Maybe it won't be February, but gee whiz, this has changed now. And I think that they've got this now as a live option, a cut in interest rates, certainly in 2025 and maybe earlier in 2025 than their previous commentary indicated. So we're letting everybody know about that, that there may be for those mortgage holders, some good news with lower interest rates coming through. Things can change. Let's not get too far ahead of us, but let's be alert to this possibility. And of course, that's a very positive force in the housing market, particularly a chronically undersupplied housing market where there's plenty of demand. Prices growth in some of the capitals has eased because of affordability barriers now rising, but affordability will improve as interest rates fall. So quite interesting there. And maybe some of the banks have got it right in terms of interest rates because they've been lowering, bit cheeky, their longer term deposit rates for depositors. So maybe they've because they don't want to risk being caught with people taking long-term deposits, term deposits, when interest rates are falling, Okay, and these are deposits I was talking about. So let's have a look just briefly at the latest rental market data, which is for November. Again, we're seeing this trend over the years so far of rental markets easing. Still very much in favour of landlords overall, but it's certainly better than what it was. And we're certainly seeing those signs in terms of rental growth. And that's, again, because we've seen this crazy rent growth over the past couple of years, 10, 20% and more in some capitals. But you can't keep doing that because people can't keep paying an extra $100 a week for their rentals. It's just like, I can't afford this. So that acts as a bit of a barrier to that in the shorter term until incomes start to catch up. Demand is still high overall, but we've got a bit more, a bit less demand, and that's increasing supply. So even though those markets have improved over the last few months for tenants, and that is higher vacancy rates overall and less severe rental increases, it's still a very tough gig for tenants out there, and still very much a market that remains in favour of landlords overall. So just a quick look. Sydney house rents here, flat over the month, up by nearly 7% over the year. Melbourne and Brisbane down slightly. Perth also flat over the month. Adelaide up quite sharply, 1.7%. Wow. But it's the annual growth that's instructive there. We're not seeing that double figure growth now. It's just starting to ease off. But interesting, Brisbane rents for houses have just started to flatten over the past year, despite unit rents being very strong in Brisbane. House rents have eased. Again, that's a factor with strong growth just pushing affordability barriers. And the other point is that tight rental markets, and people have to change their decisions. It's like, I can't afford to rent. It's too expensive. Yeah. So they say, hey, what can we do? All right, I'm going to stay at home longer. I'm going to share with my siblings. I'm going to share with my friends. I'm going to get a unit, not a house. I'm going to an outer suburb. I'm going to a regional area. So all those sort of social changes occur when there is a tight rental market, as we have overall. Vacancy rates, even though we've seen a little bit of a settling of rental growth, vacancy rates are still low. I mean, anything under 2% is in favour of higher rents. And we're still well below 2% everywhere. Canberra, 1.8% is the outlier. And most vacancy rates are just above or just below 1%. So it's still plenty of competition out there for rental properties with very low vacancy rates. They're not as low as they were, but they're still low. And a little bit of an upward trend there in vacancy rates. But just a heads up for that, as we get towards the end of the year, we do start to see some seasonal impacts with higher vacancy rates. And that's just because people have done their moving through the year, and they tend to be more settled through November, December and January. So that's houses. When we look at units, similar story, a flat month for units. Perth, strong growth, up by 1.8%. Melbourne and Brisbane, flat. Sydney down slightly, 0.8%. Sydney unit rents have actually fallen over the past year. So there's been some a little bit of a change in the dynamic in Sydney the Sydney unit rental market. Vacancy rates still pretty low in Sydney, under 2% for units, but it also has increased vacancy rates there. So a better story for Sydney units. But vacancy rates are still low in most of the other capitals, but certainly higher than houses. So a better story in the unit market, but vacancy rates still more or less in the tighter range. That is between 1 and 2, with a couple of outliers there: Darwin, Canberra and Melbourne. And Melbourne is obviously getting a lot more demand because of student numbers, particularly coming into the market. So that's our rental story. If you want a copy of that rental report from My Housing Market for November, there is a QR code, and you can scan that QR code and it will give you a PDF copy of the file. So latest auction results, just quickly, that should begin the beginning of December. We had last week. Clearance rates were reasonably settled, given it's the second last weekend of the year, but numbers of listings were down sharply, and that's no surprise because we're getting to the end of the year and people are like, hey, I've done my thing, I'm out of here, sold the house, bought the house, and we see the market petering out. But listing numbers are still tracking higher overall than where they were a year ago. So, but I think it's also interesting that vacancy rates aren't too far away from where they were. Clearance rates aren't too far away from where they were a year ago either. So this is another indication that the market's really very similar now to what it was a year ago. which is, quite a solid market environment. So Sydney auctions down sharply, end of the year from the week before. This is weekly auctions. Clearance rate also down sharply in Sydney, but a distracted market. And we did see the higher priced property areas in Sydney falling away a bit. They've been very strong over the last month. Lower north, northern beaches, eastern suburbs have all been, lower North Shore, upper North Shore, have all been quite strong, unusually strong for the end of the year, and have been keeping that Sydney market percolating along. But they fell away. In fact, lower north had the lowest clearance rates on the weekend. So it's holidays. That's what's happening, and that's what we expect. Melbourne numbers were also well down, still ahead of where they were a year ago, but the Melbourne clearance rates have actually continued to record around about the mid-60s. So it really hasn't fallen away as others have. Melbourne's been consistent in the mid-60s, but again, that's an underperformance over the year when others have been significantly higher. Brisbane bounced back, but we're seeing those typical Brisbane 50%-ish type clearance rates. Doesn't really reflect the strength of that Brisbane market, but it does have a different culture. Adelaide's really shifted downwards from very strong results a couple of months ago into the mid-60s, and Canberra bounced back, but it's been a bit up and down, as we know, this year. And just looking at the trend, you can see the seasonal impacts there in the Sydney market just falling away over the last couple of months. Melbourne, as I said, has held its own and continuing to track where it has really for most of the year in the mid-60s, the Melbourne market. And I think, as I alluded to previously, an interest rate cut will help to kick that market along if and when it comes. Brisbane back to the high 40s, low 50s. That's where Brisbane typically is, and doesn't reflect the nature of the market overall as other capital cities do if they were at those levels. Adelaide down sharply. Again, a little bit of the end of the year blues happening in Adelaide, but also it's come through a remarkable period of strength. So it's now suffering those affordability scenarios, and Canberra bounced back a little bit at the week. And if you're looking for those auction clearance rate results, you can get them on my LinkedIn channel, Andrew Wilson, Doc Andrew Wilson at LinkedIn. Saturdays between 6 and 6:30 for the headline results, and on Sundays you can get the full national report, which includes regional breakdowns for Sydney and Melbourne and the top 10 sales under the hammer over the week. If you want a copy of the latest report, there it is, QR code, ding, ding, PDF copy of the latest My Housing Market auction report, which is handy to identify what's happening in regions, particularly Sydney and Melbourne. And as we finish, let's have a bit of a giveaway. The My Housing Market Infinity Market Suburb Data app, fantastic if you're looking to find out what's happening in real time in every suburb in Australia that has data. There's a QR code, you can get hold of it and the link, but a heads up, hey, you can't get access to it without a password.
You need the password.
Get the password from Infinity. So get onto the good folks at Infinity. They will give you the password to this fantastic little app you can put on your phone or on your computer. And there's a screenshot of you can filter for price or rents. These are asking prices or asking rents currently in the marketplace. You can filter it for the capital city region or the outside capital city region in each state. So we've filtered there for New South Wales, Sydney. Looking at Blacktown, big suburb in Sydney. You can filter it for the type of property, house, unit or townhouse. We're looking at house. You can also filter for the number of beds. Oh my God, this is fabulous. So we filtered that for 5 beds. And what have we come up with? Not just the median asking price currently, but also the high and the low. So you have a range there, the midpoint, the high point, the low point of what people are asking for a 5-bedroom house in Blacktown, and the number of properties that are currently listed for sale, that's 14. And you can do exactly the same thing for rents, which we've done there. And you can see the rental data for Blacktown. And we've also introduced something for investors. This tells you the top 10 suburbs in Australia for yields. There is some, we're only looking at 10 plus sales, 10 plus listings for rents and for sale. So there is some we're eliminating volatile outcomes, but it does give you a nice sense of where the good returns are there. It's not just the yield, and these are gross yields, of course. So they don't include, of course, the costs, which are an individual thing
Yeah.
but they are the returns you get just based on the current rent and the current asking prices. We also have the vacancy rate. How's that for a newbie? So you can see what the vacancy rates are. So you can take a little bit of a scientific approach when you're doing analysis on properties in Australia as an investment proposition, and also the number of properties for rent and the number of properties currently for sale. We've looked at Ultimo there in the Sydney, and that's the top one, but that has a very high yield because it has a lot of student accommodation in Ultimo. So we should eliminate it, but we don't have a way of differentiating student accommodation in the data. We might come up with that. So we'll take that one with a grain of salt. But the rest are in the high sixes there in terms of a 1-bedroom unit in Sydney. So get hold of that. It's great. Next week, we're going to look at the labour market data, which will be interesting because we're talking economy now, not necessarily inflation in terms of interest rate decisions. We're getting the latest population data released this week from the ABS. So we'll see, and that's been important for our housing market. It is starting to settle now. We're not seeing the surge in population that we've had. So let's see how that's going, just settling down. And of course, the latest auction results. If you missed the report or you want to get some more detail on it, here is a QR code, a QR code where you can scan and it'll give you a PDF copy to the file. So that's it for me. Fantastic. Here comes Christmas. One more of our glorious Wilson Weeklies, which will be 109.
Fantastic.
Yeah.
Sounds like I need to just stay put, eat my pudding, and wait for the movement to happen.
No, get a life. No. It's all good. I like the pudding though. That's good news. Although I got to watch the pudding.
Always.
Too much pudding. So we'll see you next week, folks, 100%. And stay cool because it's pretty warm everywhere at the moment.
Thank you, Doc.
Thank you. Goodbye.
Awesome. Bye.